JJ the CPA here. Hope you're doing well. This is a very special show just for small business owners and the self-employed. Anybody can tune in and get good information. My channel is really designed to help those that are small business owners, the self-employed, and this is a show that we put together each week for you and covering a number of subjects. And in the first 5 minutes, I'm going to really cover all the subjects, but then the rest of the broadcast, I will walk through some examples, some ideas, give you a little more info. In the body of the video, you're going to have links to additional information related to this. So even if you don't want to hang and watch the whole thing, sit tight because in about 5 minutes, I will have walked through everything. All right. Hey, welcome to JJ the CPA's Small Business Toolbox.
The combination to money making, we got this. JJ the CPA is the master locksmith.
All right, so we are going to cover three things today. We're going to be talking about the 401k versus the SEP. We're going to be talking about the Single Member Llc. And we're going to be talking about the vehicle tax deduction for small business owners as well as the self-employed. I do have some videos that are related to this that I'll also put links into it that after this you can check that out for some more and additional information. Let me give you the nuts and bolts of these three things here very quickly. The first with the 401k versus the SEP. This is two different kinds of retirement plans that is available for the self-employed and the small business, as in the employer based on wages. So the 401k is an employee contribution plan, or it's the self-employed contribution plan, meaning it is in essence separate from the SEP because the SEP is what's called an employer contribution plan. And so you actually can do both. Well, which one should you do? Well, typically you would want to look at the 401k first. It does have some additional fees for third-party administration because there has to be some things reported to the IRS. But with that being said, with the 401k, it is the first dollar amounts or up to the first dollar amounts of self-employed income or wages. So if you are in essence under 50, you can put in $20,500. If you're 50 and over, then you're able to put in $27,000 because it's a catch-up. So when you're looking at when you're able to put the dollars in to the 401k, if you only made wages, let's say of $30,000, you'd be able to put in the full max to the 401k. If you had self-employment earnings up to that dollar amount, let's say $30,000, you would be able to put in that full amount. So if you had wages of $11,000, you could put in up to the max of your wages in a 401k or into the for the self-employment income. So the thing with the SEP though is that it's 25% of wages or 25% of your self-employed income. So when you're looking at this, when you're comparing, you would say, okay, well, if I can put dollar for dollar of my first fruits, my first wages, my first self-employment income into the 401k, and I don't know if we have a graphic that we can put up related to this, but when you're looking at this, the 401k, you can put in these maximum amounts. But the thing with the SEP, as I show down here below, is that because it's 25%, yes, you can put more money in because the SEP allows you to put in $58,000 in 2021. I'm going to tell you why I'm still giving you 21 here later. You can put up to $61,000 for 2022, but that would require, for instance, in 2022, $244,000 of self-employment income or $244,000 in wages, because to be able to put in that max, it's only 25% of that dollar amount. So back to that 30,000 example I gave you, well, you could put in up to 20,500 if you're under 50. You could put in up to 27,000 if you're 50 and older. And in addition to that, you can also put money into the SEP, but it's the employer that's putting money into the SEP. So when we say one versus the other, one is an employee plan, the other is an employer plan, and you can do both. Which one would you do first? Most likely the 401k. Why? Because you can put first fruits in, and then you would look to do potentially the SEP on top of that. The SEP, you do have until the due date plus extensions to set it up and fund it. That's why I've indicated still 21. Whereas the 401k, it is based on wages, it's based on self-employment income, and that 401k has to be set up by October 1st in the year in which you're wanting to have that 401k plan. Now, the next subject is a single member LLC, and this one's pretty simple. The reason I wanted to bring this up to you is that I hear often from many, well, I'm a single member LLC. So a single member LLC means two things. One, it just means that it's a one owner. The second is that the LLC, all that means is that's your legal designation. This doesn't have anything to do with how you're taxed. So if we could bring up the graphic that shows you all the different options. So a single member LLC can be taxed as a disregarded entity. Disregarded entity, all that means is that you're not filing a separate tax return, meaning it's all a part of your individual tax return. So that's where that disregarded entity for tax purposes, that language comes into play. And so if you're a single member LLC, that's what the SM stands for, single member. If you're a single member LLC, you have all kinds of choices, pretty much everything but one. So you can file a Schedule C where the self-employment income is. You could own real estate, one owner, and file it on Schedule E, page 1. If you're in farming and ranching, you would file that on Schedule F. It would be an LLC with one owner that's elected to not file a separate return, therefore it's disregarded. But you can be a single member LLC and then elect to be an S corporation that files a Form 1120-S. You could be a single member LLC that you file a Form 1120 and you're a C Corp. The only thing that a single member LLC cannot be is a partnership because it requires 2 members. So the thing to note here is that with a single member LLC, that doesn't necessarily mean how you're taxed. Now, the vehicle tax deduction, I do have a video I'm going to give you a link to in the body of this, but when we're talking about the vehicle tax deduction, that video I'm giving you a link to is really focused in on somebody that owns a vehicle inside their entity that has a separate filing, as in it's in a C Corp or an 1120-S S Corp or a partnership. I do talk about the self-employed. So later in this broadcast, I'm going to flesh this out a little bit. But if we could bring up this graphic, really with the vehicle, we have, in essence, 2 different categories. So the first category of vehicles is those that are 6,000 GVWR and under. So GVWR stands for Gross Vehicle Weight Rating. So every vehicle has a GVWR, has a gross vehicle weight rating. No, it is not curb weight. No, it is not something you get to add up. You would look up your vehicle, the exact make and model, and then you would say, if you were Googling it, GVWR after that, and that rating then determines how you get to depreciate it. So this first category is that if it's 6,000 pounds GVWR and under, then in the first year, you can get up to 19,200. The second year, 18,000 of depreciation. Third year, 10,800. And in the fourth year and after, then you're looking at $6,460. Now, the bonus depreciation is 100%. And what I want you to note there at the bottom is that it says over 6,000 pounds GVWR. So if it's over 6,000 pounds GVWR, then you can have 100% under bonus depreciation, meaning you can just write off that entire vehicle. This doesn't matter if it's new or used for either category. Now, typically, if something is 6,000 pounds or under, that's a passenger vehicle. Those are kind of, 4-door. If you're looking at, well, what is over 6,000 pounds GVWR? Usually that's going to be some kind of a heavier duty truck, just not a lightweight one, but a truck, and typically most SUVs. But don't assume it just because you got an SUV or you got a truck. Look it up. Now, if you're self-employed, you get to write that off. Now, it is to the extent of your business use. The other thing I'll note is that if you buy a vehicle for $10,000, you're only going to be able to write off up to $10,000. Okay. So there's the full subjects. I'm sure I took longer than 5 minutes, but guess what? I'm trying. So I do want you to know one thing. I love you. The second thing I want you to know is that right now we are potentially in the air or maybe at an airport. We're on our way back. So don't come rob my house, because I'm going to be there by the time you recognize or realize I'm not there. But what I'm telling you is that I believe if we did this right, because we're trying to really increase our technology, if you will, we are broadcasting live, but this has been pre-recorded. Now, if we are sitting in an airport, we're going to be hopefully engaging you and talking to you while this is airing live. But I do want to throw this out, because I'll tell you this, and I definitely don't want anybody to feel left out if I don't mention you, but we always have CSR and God's Dozer, Robert of Imagine That Toys, Robert of Philadelphia Salons, and Glenda. You know, I haven't seen Fred in a while, Amanda. Carol, CK, the CPA. Big shout out to my Group 51 that tunes in, Tony D. So saying hi to those that we're anticipating that are a part of this. I did want to mention to you that 2022 is a pretty big year. So the date that this is airing is just one day after Amanda and I started this YouTube channel, JJ the CPA, 5 years ago. So we started this channel May 15th in 2018. And we got a nice little reminder from YouTube that we're 5 years in, and we're almost at 80,000 as of the date this is being aired in subscribers, which is about 70,000 more than what our goal was when we first started. So thank you for being a part of this community. If you haven't subscribed yet, I'd love for you to do that. One thing you might note is that with our lives, only those that have subscribed are actually able to comment. The other thing that happened on May 15th, so the date that this is airing, meaning yesterday, was I'm celebrating 25 years of having my own CPA practice. I opened it up May 15th of 1997. So very thankful for that, for all those that make it happen, not only the staff over the years and the current staff, Alone is a key part of this, as well as Chloe and Tanae. Amanda plays a role more on the JJ the CPA side, but really a big thanks to those that are still carrying it. Thank you to my clients, those that are here. Thank you for being a part of this, all the support and encouragement. And I'll tell you what, when we hit June, I will be starting, in essence, my 30th year in tax world, if you will. And here's the biggest thing that happened in 2022, Amanda. What would that be, do you think? On January 1st, what would have been the biggest thing that happened this year?
We got engaged.
If you didn't hear, we got engaged. Amanda and I got engaged. We put a video up for a little while in January to announce it. Many of you were very sweet in your comments. We actually did get a few cards related to that, so thank you for all the support. Okay, so let's get back into these other subjects. We're going to talk about the 401k versus the SEP, the single member LLC, the vehicle tax deduction. The reason you might want to continue to listen is I'm going to give you some examples, some stories, working with some of the financial advisors, working with finance managers at the car dealerships, right? The ones that are like, oh, I'm a salesman and I know everything about the car, but gee golly, I don't know anything about numbers. Gee golly, I don't know anything about financing. You're gonna have to go talk to the finance manager, and then they go back and they kind of tell a couple of jokes, check on the news. Then they come out and they're like, well, the finance manager is still looking at the numbers. So we're going to talk about a few stories related to that. And also when we're talking about the single member LLC, we're going to talk about maybe what some of the advantages are, especially for those that have set up a single member LLC, maybe why you would consider doing something different in how you're filing. So when we're talking about the 401k, we're talking about the SEP. If you don't mind, let's pull up that full graphic, because I really want to drive home this. You can do both of these. And then what we like to do is get confused and go, well, what do you mean I can do both? It's just what I told you. You can do both. Because the 401k is, in essence, when I say it's an employee contribution plan, that means that out of the employee's wages, whether you're the owner in the business or not, you put your own money in the 401k. Now, that language sounds a little funny when we're talking about the self-employed, but for the self-employed, you still, in essence, in the law, are allowed to put into the 401k. And in essence, you're using your net income to put into the 401k, which means you can put in first fruits. So with the 401k, if somebody, I gave you that example, they're paid a $30,000 wage, they would put, and they could put up to $20,500 into that. If they're 50 and over, there's a catch up of $6,500. So they could put up to $27,000 into that retirement. Self-employed, if you have a net of $30,000, depending on your age, you'd be able to put in the max. Now, I told you on the 401k that there is a cost to it. Now, there's not a cost to the IRS, and most tax preparers don't do the reporting, but there's a Form 5500 that has to be filed with the IRS. Typically, your investment advisor is going to have that resource for you. On average, that is around $1,500 a year to get it set up, to maintain it, do the reporting at the IRS, but it allows you to put more in. Now, I'm not going to go into the detail on the simple plan, but there is a simple plan that you can put money into, and there is no real cost other than about $50 a year, but you're not able to put as much money in. So I've talked about that in other topics. But now when we pull that graphic back up, when we're looking at the SEP, the reason I say you can do both is because you can, but now the SEP is an employer contribution plan. So for the employer of the employees, doesn't matter if you're an owner or not, then the business can put up to 25% of wages into an SEP plan. Now, if you're self-employed, it would be your business, your sole proprietorship. Doesn't matter if you're a single member LLC. Remember, I told you earlier, it just depends on what form you're filing. But if you're self-employed filing a Schedule C, Amanda's over there yawning, boring her. Hopefully you're not bored in the audience. But with that being said, when you're putting money in as a self-employed individual, it's your business putting money into the SEP, into that plan. So it's both. So again, the self-employed could put, if they had 30,000 of net, that max, depending on their age, and they could then do 25% of whatever that net would be. So if their net was 30,000, then they'd be able to put 7,500 in for the SEP. That would be the employer, in essence, portion. Now, the one thing I want you to note is that with the SEP plan, you have until the due date of the tax return plus extensions to actually even set up the plan and fund it. Why is this important? Well, I gave you on that graphic that for 2021, you're able to put in up to $58,000 into the SEP. Now, if you're self-employed and you filed an extension, you still have time to set that up and fund it all the way until October 15th, because that's when your tax return is now extended to. And you would get the deduction on the 2021 tax return. Now, the one thing I want you to note is that if you are doing a 401k plan, it's too late to do anything for 2021 because that had to have been set up by October 1st in 21 for there to be a 401k in 21. The other reason I want you to also note that with the SEP, if you paid yourself wages or you paid your employees wages and you extended then the business return, right? So this would be either a partnership, an S Corp, or a C Corp, and you decide you want to do a SEP, well, that's an employer contribution plan. Now, whatever you do for one employee, you must do for all in terms of if you're going to do 25% for yourself as the owner on your wages as an S Corp or a C Corp, then you have to do 25% for all the employees. Now, in a partnership, you can't pay yourself wages. Therefore, you'd have self-employment income if you paid yourself guaranteed payments down at the individual level. But what I want you to note is that with the SEP plan, it is the same for all of those. So if you're self-employed and you have employees that you're paying a W-2 to, then if you put 25% of your self-employment income in, then you got to put 25% of their wages into the SEP plan. But the other reason I wanted to show you then the example for 2022 is that you still have time to put money into either a 401k for 2022 or into a SEP for 2022. Now, for 2022, you would have all the way until the due date in 2023 plus extensions in 2023 to actually set up and put the money in the SEP. If you want to have a 401k this year in 2022, you have to set that up by October 1st this year, and you have to have it funded by January 15th of 2023. So the reason I'm telling you that is that if you do want to max out your 401k, you got to get after it on or before the end of the year. You got to run that through wages. Now, for the self-employed, you do have to have that plan set up. You do need to show that you have a 401k. You have then till January 15th to put the money into that 401k. Now, for the SEP, I want you to really hear this, okay? I want you to hear this. If you are putting money in a SEP based on wages, so this would be for business owners that are in a C Corp or an S Corp that are paying themselves wages. If you wanted to put in the max for 2022, you would need to have wages of $244,000 to put in the max $61,000, right? Do you see now the difference? To put in the max SEP, it's a percentage of wages. The 401k, well, it's first fruits. So when we're looking at the SEP versus the 401k, you can do both. If you were to pick one or the other, it would be then me saying, well, how much do you want to put in? Because remember, with any retirement plan, you're just putting money through the doorway. So whether it's into a Roth or a traditional IRA, 401k, SEP, simple, 403b, these are just different doorways into the same room. Because once the money goes through the doorway, it's in the room, it's inside retirement. It's called qualified funds that are inside the retirement, and then it's going to grow tax-free. Now, if you put money into a Roth, it's going to come out tax-free. Of course, there's some other qualifications. For example, you got to leave it in there for a period of time. But for any of the others, it's going to grow tax-free, and then when you pull it out, it's going to be taxable. If you wait till 59 and a half, you won't pay an additional 10% early withdrawal penalty, which is just another tax. So when we're looking at this, whether the money goes in through the SEP doorway or the money goes into the 401k doorway, it still ends up in a pool that's qualified funds. It's going to grow tax-free and then be taxable in retirement. The other thing I want you to note is that when we're talking about these things, when it goes through any of those doorways and then it's in the same room, this money can go into the stock market, bonds. It could sit in money market. It could go into a real estate investment trust or REIT. There are some ways that you can do some very self-directed IRAs. Please don't listen to anybody on YouTube that's going to tell you about these, because they're probably going to tell you wrong. You need to get somebody that specializes in it. It's not easy to do. You have to get with a broker to do self-directed. If you say that you're doing it, congratulations to you. It's probably wrong. Probably something that you better double check on, because it's not easy to do a self-directed no matter what you've been told. So with that being said, let's go into our next subject, which is the single member LLC. And the thing is that when I'm talking with clients, especially when I would bring on new clients, so I'm fortunate enough I don't have to bring on new clients anymore. I haven't really since 2018, other than two lucky individuals. They may say, I think that it's neat the way it came about. I'm not going to tell you who they are because you're going to be like, wait a second, how come they got to come in? But with that being said, what I want you to know is that when new people come on board and I say, well, how are you taxed? Well, I'm an LLC. That tells me nothing. That tells me if I'm talking to you here in Oklahoma, or I meet with you in the airport out in Miami, and I say, hey, what's your citizenship? And you say, well, I'm a U.S. citizen. Great. Now I know that you're an American. Now, if I say, well, where are you from? And you say, oh, I'm from the U.S. Well, are you? I mean, you're probably from a specific state. And the reason I'm telling you that is an LLC just says, here's how I am legally set up, period. Okay. Limited liability company. And the thing about the LLC is it can be taxed as anything. When you say single member LLC, all it means is there's one owner. It doesn't mean that you're telling me how it's taxed. How it's taxed is what form are you filing? Because whatever form you're filing or schedule, those are the rules that you're following. So let's bring up that graphic about the single member LLC. So you are a single member LLC. Again, all that means is you're a one owner. Now, many look at it and go, well, single member LLCs are those that file Schedule C. Okay, you're either talking to somebody that unfortunately is just ignorant, or they're arrogant, or they're just, in essence, somehow in bizarro land, that single member LLC is telling us anything about how you're taxed. When we're talking about how you're taxed, it would be then what makes sense. So I've given you this earlier, all the different options you have and what you can't do. But now let's talk about when would you want to file a Schedule C, a Schedule E, or a Schedule F. So for a Schedule C, this is a sole proprietor. So this is something that you're actively involved in, and it is a side business, a side hustle, or something in essence that you're getting 1099 income on. So Schedule C, the net income is going to be subject to self-employment tax. I've talked about this before. Now, I'm not a fan of Schedule C, but let me tell you when I am a fan of Schedule C. When somebody first starts their business, they haven't really gotten it off the ground. Many times I will say, hey, you've got your LLC set up. We get to be anything. An LLC can be anything. A single member LLC can be anything but a partnership, because it requires two members to be a partnership. But my point is I tell a client, listen, just be an LLC. We're going to get the tax ID number and we will classify it as disregarded. All that means is you're doing nothing after that except reporting the information on Schedule C. And let me tell you why. If you're just getting started, and I've got a client, it's like, well, we don't really need to yet file a separate tax return. Let's just keep this easy and inexpensive, especially while you're getting started. And we won't need to worry about paying yourself any wages. When you're a Schedule C, it's just, honestly, it's a little more loosey-goosey than having a balance sheet. It's just a little easier. So when people come to me and they're like, listen, I've invented the best socks for squirrels, and it is going to help them climb trees better, and they can store acorns in the back of them, right? It's like, okay, boy, that could be $1 million idea. So maybe we need to go ahead and set up the LLC, because that's your legal structure. We can then use it as we move forward. But as you then plan this out and you are going to somehow market to the community that looks after squirrels, then as you grow it, then we may decide to do something different with your tax structure. But being in Schedule C, let's keep it easy. The other part is probably not because it's something for squirrels, but when most businesses start out, this is something that probably it's not going to have a lot of net income in the first year. It means there's going to be startup expenses, buying equipment, lease, putting the extra dollars into, whether it's signing bonuses or getting employees on and train. There's a lot of upfront money that goes. So it's very easy for a first year to have a loss, especially also because most of the time the revenue doesn't start coming in the first day of the year. So when you have losses on a Schedule C, you don't have to worry about basis. It's just you're able to take the loss, if you will. Yes, it's a little more complicated than that, but all I'm saying is it's easier to realize and experience the loss with a Schedule C. Now, when am I not a fan of somebody having a Schedule C? Well, after it's gotten successful, they have somehow really tapped this market worldwide for squirrels. Now, I don't know if squirrels are worldwide, but nonetheless, they've really cornered the market and they're going to have net income. At least I've got Amanda over there laughing. They're going to have net income that's above about $30,000. Then it starts making sense, in my opinion, if we're still talking about a one owner, to be an S Corp. And then you would file a Form 2553, which is just telling the IRS I want to be an S Corp. There's other rules and regulations to that. I'll make a note to give you a link to it. But guess what? It's not something you should really be getting off of YouTube. You need to be hiring a professional. This is not a DIY when you're filing a Form 2553 that could save you millions of dollars in self-employment taxes over your career, okay? Do not take your hand, and make sure, and then take this and put a hammer on it because you didn't want to get with an advisor. to file the schedule or to file the S Corp. But nonetheless, all you're doing is filing a Form 2553. You're still an LLC. You're still the same EIN. You're not getting anything different or new. It's the same name. You hear me? Because I have clients and I say it to them and it's like they didn't even register. It's like I just spoke some foreign language to them. I say, let me just say it again. All we're doing now is electing for your entity to be taxed as an S Corp, which is only done at the IRS. See, it's still an LLC. It's still the same EIN. It's just now going to be taxed as. Or you can elect on Form 8832 to be a C Corp. C Corps are no go, y'all. I don't have any C Corps now. I have 0 clients that are C Corps. Why? Go ask a professional. If they're any good, they'll be able to tell you pretty quick. And we'll talk about it probably in a future episode. But if you have more than one owner, then you could become a partnership by filing also Form 8832, meaning you're just filing forms to tell the IRS how you want to be taxed. Now, why would I say to you, I'm not a fan of Schedule C after you're netting about 30 grand? Well, the net income on Schedule C is subject to self-employment tax. That's a 15.3% tax. So you're just laying on the railroad tracks and just in essence, whatever your net is, you're going to pay that tax. Now, that's up to $147,000 in 2022. After that, it's 2.9 up to 250, and then it's 3.8. You're right. I don't want to get in the weeds, but I do know I have good, wonderful tax professionals, fellow EAs, CPAs, those have been doing this a long time, that they would be interested in that info. But what I want you to know is this: on that $30,000, your self-employment tax is $4,500. That's in addition to your regular income taxes. It's $4,500 in self-employment tax. Self-employment tax is nothing more than Social Security and Medicare taxes. That 15.3% you pay on whatever the net is, whether it's 30 or 40 or 50 or 60, take that net times 15.3%. That's why I'm not a fan of it. You're just paying it in without any decision on your part. When you're an S Corp, that net income is not subject to self-employment tax. An S Corp is a flow-through entity, meaning an S Corp does not pay its tax. It's not an entity level tax at the federal level, and whatever it nets, you then pick up on the individual return, but on Schedule E, page 2 versus Schedule C. And because that net income, which would be pretty much the same as if you had it on Schedule C, but by it being in an S Corp and then reflected on Schedule E, page 2, it is not subject to the 15.3%. But to be an S Corp, you have to have a separate tax return. As an S Corp owner, you need to start paying yourself wages. You have to be 100% strict of the money's all going into your business account. You have to take a look at distributions. You're probably getting QuickBooks, and you have to track your numbers so that you also can generate a balance sheet. There's a limitation to your losses that's only to the extent of the money that you put in or the money that you loan the business. So that's why there's more complication to the S Corp. So if in year 1, we're setting up mittens for squirrels that stores acorns that may have a loss, a Schedule C makes a lot of sense. In year 2 or 3, when it skyrockets, mostly because probably they're doing a YouTube channel and people can't believe that people are actually coming up with mittens for squirrels that also store acorns for them. And they might find it funny. No offense to those that are fans of squirrels or that build mittens for them. But at the same time, they might be making a ton of money because of the fact that that is probably not a reality that anybody's doing that. Point is this: once they start making the dough, then we look at other options. Let's bring that graphic up. So why am I also showing you Schedule E? Well, Schedule E is where rental property is shown. So you could have an LLC, right, for every property that you own. Why would you do that? Separate out the liability, separate out the asset from one asset to the other. But you don't then need to file a separate tax return for each LLC if you have one owner of it, meaning you. So you get the liability protection of the LLC owning the real estate, meaning it's going to separate any liability that happens in that LLC from your other LLCs and from you. So it's liability protection. But if it's a single member, again, only means there's one owner. Then if it is owning real estate, it goes on Schedule E. And net income on Schedule E is not subject to self-employment tax. Now, I will tell you this, real estate rules for Schedule E are different than if you had a LLC that owned real estate and it filed a separate tax return. Typically, a partnership would be a fit there, assuming you have a second owner with you. But nonetheless, when we look at then a disregarded entity Schedule F, this is now somebody that's in farming and ranching, and that net income is also subject to self-employment tax. And so I would be a fan of a Schedule F the same way I would be a fan of Schedule C. And then we talked about the 1120S. Let me tell you in 1 minute why you would not want to be a C Corp, whether you're a single member LLC or you are a multi-owner. The C Corp typically is for those that, I get it, right? That person that's coming to me and they're like, no, listen, I'm taking this company public. Okay. Look me in my eyes, JJ. These mittens I'm making protect a squirrel from all weather. They're rain proof. They can float with them. It helps them jump from one tree to the next. They can walk on water. It helps them ski. And they can hold up to 14 acorns in the back of each mitten. And each squirrel could have 4 mittens, which means, okay, I'm having fun with you, but the person that's going to sit down and now say, so I'm taking that company public, 100%. And I've already got investors lined up. I've got a venture capitalist and they're going to put in millions and we're going to have well over 100 owners. And it's starting now, JJ. We're doing it right now. I got a whole team and money and investors. Okay. That's when it might make sense to be, in essence, a C Corp. Why? Because a C Corp pays its own tax. That's not a good thing for a small business owner, and I'll tell you in a second why. But it pays its own tax. When you have multiple owners, they don't want to have to pay tax on whatever the net income of the business is. They only want to pay tax on the money they're getting out, which is either wages or dividends. Now, with a C corporation, there's double taxation. Legal, it's constitutional, double taxation. How? Simple. Whatever the net income is on a C Corp, that business is going to pay tax on that net income. If they then pay out dividends, those dividends are not a tax deduction. So you take a C Corp that nets $100,000. Well, under current conditions, the tax rate is flat, 21%. Now, don't get too excited, okay? Because when I tell you the rest of this, you're going to be like, oh, yeah, that's not really that good a deal. So the business, the C Corp, is going to pay $21,000 in federal taxes. Now, if it pays out that $100,000 as dividends, then the owners that receive those dividends are going to pay tax on it. Now, I know right now you're like, whoa, 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 but they're going to pay capital gains tax there, JJ. You know, capital gains tax is way low. Okay. Now, let's just assume that somebody that owns a C Corp is not destitute and in the lowest of tax brackets. Okay. They're just kind of in a normal tax bracket. You know, they're making like more than 60 grand a year. You're going to be in the 15% tax bracket, okay, for your capital gains, right? So dividends, assuming they're qualified, do get taxed at capital gain rates. But for most, don't even play the game with me because there's no way that math works out. And if it does, you're not making very much money. And why do you have a C Corp? But my point is that I'm telling you, for 99.99999% of those that have a C Corp and are getting dividends, they're at least paying the 15% in capital gains. So let's add it together. 21% is the corporate tax that was paid, $21,000. And then that individual is going to pay 15%, right? So 15,000. So together that's 36%, or together we're looking at $36,000. The highest tax bracket for an individual is at 37%, but you don't get into that to well over 600,000 married filing jointly or well over 500,000 single. So you allowed yourself very easily to all of a sudden pay 36% in taxes, right? That'd be like, you know, I've come up with this new thing where it's not putting a gun to your head, but if I were to put this rubber band to my head, right, and I let go of it, okay, but then I turn it that there happened to be a little, like some kind of little BB at the end, and then I let go of it, boom. That's what you've just done to yourself by having a C Corp, thinking you outsmarted things. And if your tax advisor is telling you that a C Corp's good and you don't have a bunch of owners and you're netting 100 grand, they're an idiot. I'm just telling you right now. They're lazy. They don't know what it is that they're doing. They could not convince me otherwise. Okay. Because the way they could tell you then is, oh, well, you pay yourself wages. What? Because I hear this as well from dumb tax advisors, which there's no dumb tax advisors tuning into my channel. But you may have a dumb tax advisor, because I'm telling you this, when I bring on new clients, I'm like, oh, well, I'm a C Corp, and they told me C Corp's good, and I don't ever have to worry about paying corporate level of tax because I just bonus myself out whatever the net income is. Okay. Well, guess what happens when you pay yourself wages? You ready for this? You're going to pay Social Security and Medicare tax on it. You're going to pay 15.3% in total, 7.65% withheld, 7.65% match, 15.3%, yo. Okay. And now it's wages, and the wages are ordinary taxed. So some idiot, and that's why I can say wholeheartedly, an idiot tells you that a C Corp is better and bonus out the net. The reason it's an idiot move is that you're going to pay regular income taxes on the wages, plus all the wages are subject to payroll tax, which is 15.3% up to 146,000. Above that, it's 2.9, and above that, it's 3.8. Okay. Plus ordinary. You do not come out ahead. And guess what? You didn't avoid anything. So for me, let's bring that graphic back up. The C Corp just is not the language that we're dealing with. I don't have one client that's a C Corp, and they do over 25 million. And they're great friends of mine. I work with the owners. I have a bunch of other businesses, and I just visited with them going into this tax season. I said, hey, I think this is going to need to be our last year of me doing the C Corp, because you're now getting above the 26 million mark for the average gross receipts, new rules, regulations. Let's get in a bigger firm that deals with this every day, because I don't. But I'm still going to work with the family, work with their other businesses, and then just be an advisor. But what I'm telling you is that the C Corp, for those typically that are doing less than 26 million, is not really the way to go. Now, when we're talking about a partnership, when does it make sense to be a partnership? When you have two owners. Now, you can't be a single member LLC with two owners. You would then have to file either a partnership, an S Corp, or a C Corp. All right, let's get into the vehicle deduction as we round this out. And right now, I don't know. It's going to be interesting to see, Amanda, if we're going to be able to comment while this is up.
Yeah.
And I think this is actually going to post as a live, so kind of neat. But I will tell you this, we will be on live as we move forward. This was something that was kind of out of our control, and with some changes that got made. So this week is actually a little bit unusual. For those that tune into my CPE, I'll give you a link to that, but I give CPE, I have Group 51. Those are also never done it before, but also pre-recorded. So let's talk about the vehicle deduction. Go ahead and pull that graphic up, Amanda. So again, when we're talking about this is the one that gets everybody so excited, right? This is the one that the clients are like, can I have your cell phone number? Because when I'm at the car lot, I want to be able to call you to make sure that I do this right. And it is fun and it is exciting, because it's like, wow. But what's cute, and I'm just going to say it that way, what's cute is how serious my clients, and I say it too if one of them is sitting here, how serious they take this right here. The rest of it, it's like, hey, just tell me what to do, JJ, or hey, I brought this, I didn't know if I could do it or not, so I did it. Let me know if I could have. On the vehicle, they don't want to misstep, and so I love it. So again, we have two categories, 6,000 pounds and under GVWR, or over 6,000 pounds. So here's how it usually goes down, right? Haven't heard from a client in a while, call out of the blue, might be on a Saturday. Hey, JJ, I'm here at the car dealership. I'm like, all right, boom. I'm in tune. Let's rock. Okay. And they're going to buy. Now on the leasing, I can't wait till we go over it in a future small business toolbox show. because I've got the secret on how to ensure you get a good deal on a lease, or how to know you're not and you just got to walk away. But with that being said, when we're talking about a purchase, so when we're talking about getting this deduction, the depreciation, it is only on a purchase, not on a lease, period. Don't even come and tell me, well, it's some kind of capital lease, blah, blah. No, it's not. It doesn't exist in a vehicle, okay? Well, it's a smart lease. Well, you just got hit in the head 48 times with a hammer if you did what's called a smart lease, okay? Those are not smart. Don't do a quote unquote smart lease. And by the way, those still don't qualify for getting this depreciation. But this depreciation, okay, that we're talking about is, oh, you can see my finger. This is my signal to Amanda. Hey, let's put up the graphic, and then you don't get to see it. But when I'm like, hey, let's pull down the graphic, I move my hand down. But let's say that somebody bought a $60,000 vehicle, okay? Well, in the first year, it would be $19,200 if it's 6,000 pounds GVWR and under. The next year, 18, then 10.8, and then 6,460 after. But here's what you need to know. That would assume that the vehicle is 100% business usage. So if you're in a situation where you buy that vehicle for $60,000, right? But you only use it, 80% for business, then whatever those amounts were times 80% would be the amount of depreciation that you would realize. And so the reason it's just smart to know that is that I do have clients and they say, hey, I'm getting another vehicle. And I'm like, okay, well, we have one in your business already. Are you trading this in? Are you selling it? And I'm like, oh, no. My kid's got their license, time out. No way. Not doing it. Don't do it. Don't do it. Don't let your advisor tell you do it. You didn't win anything. You're not pulling anything unless your kid works for your business. They're in you're some kind of business and it's a delivery business and your kid's driving that car to deliver vehicles and maybe taking themselves to school once in a while. The point is that's rare. Okay. That is rare. But just buying your kid a vehicle, okay, and they're just going to run themselves to school and their own job. You don't run it through the business. And here's why. It's not going to have any business usage for starters, which means that none of that's going to be a deduction, number one. But here's the other reason why. And I can tell you of 3 circumstances in the last 25 years of having my own practice where I've seen circumstances like this. Okay. Now I'm going to tell you this was with clients that it happened to them before they came to me, but they had kids that were in the vehicles that were in the business name, and regardless if that client was writing them off or not. Now I'm going to tell you, I didn't write them off. Okay. But what I'm telling you is that kid got in an accident and then it fell under the business. Okay. And there was insurance to cover it, but the auto, in 2 of the circumstances, the auto insurance said, hey, you didn't tell us that this vehicle was titled in the business. So guess what? We ain't covering this accident. And then in the third one, it was, well, we're only going to cover up to the uninsured motorist. And then after that, the person that's in the accident, they're going after your business. And the business got sued directly and did have to come out of money out of pocket. So don't be all hee ha ha. Oh, I'm writing off my kid's vehicle. That's dumb. Don't do it. Okay. For the liability alone. Now, again, you got a pizza parlor shop and you got a little delivery van. Well, of course your kid can drive it just the same as any other employee. Let's not be silly here. Okay. Now, the other thing I want you to know is that when we're talking about the vehicles here, when it is over 6,000 pounds GVWR, remember GVWR is gross vehicle weight rating. Okay. Because I tell that to clients and they're like, well, I'm looking on here and it says the curb weight. And I say, if I was next to you, I would do an old fashioned Laurel and Hardy slap upside the back of your head and say, is it GVWR? Because you can find all kinds of weights, curb weight, the load rate. And it's like, why are we making this difficult? It's GVWR. Okay. I'm having fun and I have fun with my clients. So you're kind of hearing how I talk to some of my clients because we're having fun together and they know that we're having fun. But it's GVWR. No, you don't get to do anything else. But if it's over 6,000 pounds, then you can take bonus depreciation, 100%, new or used. 100%. So if it's $60,000, you're getting a $60,000 deduction. But again, it's to the extent of your business usage. Okay. So if you use it 80% for business and you bought a $60,000 vehicle, well, yes, you initially get 100% write-off, but only to the extent of your business usage. So it would be 60,000 times 80% business usage as your allowable deduction. Now, you can take on over 6,000 pound vehicles, 6,000 pound GVWR. You can do Section 179. Here's why I never do Section 179. And I hope as a tax advisor, you've made it to here and you're going to hear me because it gets overlooked. And the reason I'm paying attention to this is I'm doing seminars. I travel. I do them online. I do CPE to fellow tax pros, CPAs, and EAs. And it's my job to pay attention to the minutia. But you ready for this? When you take Section 179, if the business usage ever drops below 50% in that year that the business usage drops, you have to recapture all that depreciation, yo. That's no go, right? There's no reason to do Section 179 on an over 6,000 pound vehicle. And you don't get Section 179 if it's 6,000 pounds or less. You don't get Section 179 depreciation. Section 179 just means the code section. And that is why I don't take Section 179 on vehicles, so that if that business usage drops. Now, we'll tell you this, when you have clients, and don't even think like that you should never listen to people on YouTube, side note, side rant. They're going to tell you something that's some like, oh, a little secret and you can do. It's just going to get you in trouble. Remember, IRS watches these videos too, number one. But when you're watching videos and they're telling you something, and you're like, whoa, they just told me something. You need to run it by your advisors. And I would advise you to not tell your advisors, hey, I heard on YouTube. Okay. Not even if you're saying you heard it from JJ the CPA. But what I'm telling you, okay, is related to getting this deduction, okay? You want to ensure that you're doing it properly. So if you have a business owner, okay, and you're now wanting to go, well, how do I make sure I get the write-off? Well, if you're self-employed filing a Schedule C or a Schedule F, because you ain't getting this on Schedule E, and if you did, you shouldn't have, okay? It's just how it is, okay? Now, when you take it on Schedule C or Schedule F, or somehow you found somebody that snaked away that you're taking on Schedule E, which is just not correct. Doesn't have to be in the business name because it doesn't really matter. Now, it might make sense to have it in the business name. Be smart if you had it in the business name. Why do you have a business name? Why do you have an LLC if you're not going to put it in the asset? But you don't have to, okay? And if you don't have an LLC, you're just writing it off. My point is, if it's on the individual return, you're just writing it off. Here, hand that to me. Yeah.
Sorry.
Yeah. Amanda's keeping herself occupied by literally playing with Superman over there. She's like doing this, kind of scratching her face with it. So this is a kind of a cool Superman right here. Now, if you have a vehicle and you're filing an S Corp, a C Corp, or a partnership, it has to be in that business name, period, the end, period, the end. Guess what the IRS does when they come and audit, which is rare. That's me knocking on wood. No one's at your front door. That's me knocking on wood, and I'm going to knock a lot. You know why I'm knocking a lot? Because I've never had an adjustment in an IRS audit on a tax return I prepared. Boom. Right? 30 years in the biz. Now, part of it is that I got good clients. The other part of it is we have good documentation. But when there's an IRS audit, one of the first things they're going to look at is the vehicle. Now, I'm going to do another little side rant, okay? A vehicle is not a flag. Taking a vehicle is not, ooh, IRS going to come and audit you. Because if you're being told that by your advisor, hang up on them and go find somebody else. Fire them as fast as you possibly can, because any advisor that tells you that you can't do something because it's a flag is an idiot. Any advisor that tells you like, well, the IRS may come and question that is lazy and weak. And the reason I say that is they're scared of the IRS. That means also they don't know what it is they're doing, because all they're trying to do is use a false urban legend boogeyman under the bed tactic with you to basically not do something they don't know how to do. Okay. So deal with an advisor that knows what they are doing. And here's the test for it is, how do I take care of, in essence, writing off the vehicle? Well, it's having it titled in the business, because if there is an audit and there is a vehicle, they're going to ask about it. But guess what they're going to ask? I just want to see the title to the vehicle, please. And I want to see the loan to the vehicle, please. Because I'm telling you, it's got to be 9 out of 10 that they didn't title the vehicle in the business. So for an S Corp, C Corp, or a partnership, then the IRS just goes, oh, that's not allowed. And you have no argument. It's not allowed. You do not get the deduction if it's not in the business name. Self-employed doesn't matter. Okay. Even if you have an LLC, doesn't matter if you're self-employed, filing Schedule C or Schedule F, or you snaked it on a Schedule E. Okay. But if you're filing a separate tax return, it 1000% matters. You've been told different, they're wrong. If you don't have it in the business name, then what you should be doing tomorrow morning is down at the tag agency, at least adding the business name to the title or transferring it. It's not a sale. It's not a gift. Talk with the person behind the counter and just tell them, I own the vehicle. I own the business. It should be very little fee for me to just transfer the title, or at least add the business name to the title. And then more importantly, let your insurance company know, your auto insurance company know, that you now have a vehicle that is titled in the business, or is titled in the business with you individually, which is allowed in some states. And the reason for that is that the insurance company has to know that if this is being used for commercial use, doesn't need a sticker on the side and a magnet and to pretend that it's for advertising. All that stuff's just hooey gooey, doesn't matter about anything. All that matters to the IRS when they first walk in is it titled in the business name for C Corp, S Corp, partnership. Now, if you're self-employed and you get audited, then probably the first thing they're going to want to know is, well, show me that you actually have the vehicle. Let me see that you own it, the purchase statement of whatever year it was. Okay. And then they're going to want to see a mileage log, because they want to know what your business usage is. Now, for the S Corp, the partnership, and the C Corp, then the next thing they're going to look at is if there was any financing on it, is they want to see the agreement. And part of the reason they want to see the sales agreement is to see if you were actually leasing the vehicle. Because if you're leasing the vehicle, you don't get the depreciation. You just get to write off the monthly amount you're paying for the lease. It's basically rent, and only to the extent of business usage. But they want to see those two things. Yes, they may then ask, can I see a mileage log? Now, I'm knocking on wood. I'm knocking on wood. I'm knocking on wood. I've actually never had an IRS audit where after they ask for the title, which they've done 100% of the time, and then probably 80% of the time they've wanted to see the loan document, they've never asked for the mileage log. But guess what? My clients have it. And I will tell you this, for S Corps and C Corps, we always pick up personal use of that vehicle as taxable wages, a fringe benefit on the W-2 if they have it. Okay. So if you have a business vehicle, unless you literally show up at the office and then get in the business vehicle and go do stuff, come back to the office and then get in your personal vehicle, it's pretty much not possible to have 100% usage of a vehicle inside your S Corp, C Corp, or partnership. Okay. Now down at the self-employment level, it's all about the mileage log in terms of how many miles did you drive and then how many miles were for business. Now I'm going to tell you a little side note, and I've won an audit twice. The IRS agent, actually very cordial always. It's like, wow, thanks for showing that to me. I didn't know that. But if you home office, this is for self-employed. Okay. Self-employed as filing a Schedule C or Schedule F. Okay. If you're officing out of your house, that's the only place you are. Okay. Right. And I mean, like, you have a real office. You're not just pretending to have one. Okay. You have a home office. There's no commute for you. So when you leave the house, okay, many think, and you're wrong, you're dead wrong. Many think, whoa, 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 no, no, no. When you go from your house to your first client, that's a commute. No, it's not. That is for Form 2106 when you're an employee. Don't confuse the rules. Know what it is that you're doing. Do not confuse the rules. Now, when we're talking about for an S Corp or a partnership or a C Corp, if the vehicle is more safe at the employee's house than it is at the business, then it is not a commute between the office and the house. Okay. This is the part where you kind of need advisors. But at the end of the day, my clients that we have corporate vehicles, they're at least 20% personal use. I mean, I can't even think of a client right now that they don't have at least 20%. And even if they try and tell me more, I'm like, nah, it's really just 20%. Because the thing I want you to remember is this: when you're dealing with the IRS, it comes down to documentation. It comes down to your intent. And our intent is to follow the law. We want to take deductions, but no more than what we're allowed, no more fair share, if you will. And same thing with paying taxes. So we covered 3 subjects. You know, the first and second episode, I hope you'll check those out. I'm going to give you links to a number of these subjects. In the body of this, I will put down the 6,000 pound GVWR and under, and then over 6,000 pound GVWR, because that's usually the one that's like, what was it? What was it? GVWR. I'm not going to give you the dollar amounts because I'm going to give you the link to where you can get those dollar amounts. Let's see. And then also I'll give you a link related to the retirement plans that you can go to. And with that, what else are we supposed to cover, Amanda? We're excited. We're done. We got to put up the graphic. I forgot again. I was supposed to say excited at the beginning. Yeah. Yeah. And does it do, so you just hit it once and then it stops? You don't have to click it to stop it. It's not going to run on a loop. Yeah. Hey, play our beginning video real quick. Again, I actually want to watch it. I like it because you just can't.
The combination to money making, we got this. JJ, the CPA, is the master locksmith.
That was really just an excuse for me to take a drink.
Oh, well.
Yeah.
Almost any time you want to, you just let me know. Here, I'll give you some five.
Well, I do miss being actually live with you. Hopefully we've been able to tune in with you during the hour that this came out. Our plan is to always be live on Mondays at 4 p.m. Central Standard Time. Check out the link below for CPE, my website. Hopefully you've subscribed by now. I'd love it if you would. Trying to get up to that 80,000. Of course, I don't make any money based on the number of subscribers, but it tells me I'm putting out good content. Now, I have been struggling to put out videos just based on time constraints, and that is really just related to my tax practice. I'm having a great time getting out to see my clients and being very, in essence, proactive with them. I've had a lot of meetings. We're going to be going into the next couple of weeks, and then we'll be into June. And then I'm kind of looking pretty wide open from there. So thanks for sticking with me. Thanks for tuning into this channel. Thanks for tuning into the show. If you made it to here, I love you. I appreciate you so much. Thanks for everything. All right. And with that, I always have to say this. Thanks for tuning in. I'd love it if you'd subscribe. Oh, wait, you have to play a little video at the end. I see you're getting ready to hit end broadcast, but you got to play our little end video.
Okay.
Yeah. No, not that one. The dun 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 dun. Oh, we couldn't get that one?
Yeah, because of the MP4 thing.
Oh, okay.
I'm sorry.
All right. Well,
Next Monday
we'll have it. All right.
Tune into something.
Tune into that. Okay. Well, since I said that we're going to play a little video, you can play the toolbox one. All right. Here we go. Hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me.
The combination to money making, we got this. JJ, the CPA, is the master locksmith.
We'll see ya.